Hello, property navigators. Brisbane's home values have increased at over 5 times the pace of Melbourne's since the onset of COVID. The result? Brisbane's median house price now sits about 11% higher than Melbourne's, a complete role reversal from the pre-pandemic era when Melbourne's values held a 37% premium. Melbourne, on the other hand, has spent the last couple years in the doldrums. Since March 2020, Melbourne's home values rose only around 8.4%, the lowest growth of any capital city, and it even saw slight price falls through 2022 to 24. This lag has pushed Melbourne's prices well below their long-term trend, and some even below replacement costs, setting the stage for potentially a strong rebound. So where should you buy right now? Brisbane? Melbourne? Well, Brisbane's recent boom has delivered explosive growth, nearly doubling values in a decade, while Melbourne now offers relative value and a catch-up opportunity. But that's not to say one is better than the other for you and your specific investment journey. By the end of this video, you'll have a clearer understanding of where each city is at and which, or perhaps both, might fit your investment strategy. Let's go! Instead of constantly repeating the labels Greater Melbourne and Greater Brisbane today, I'm going to use short form Melbourne and Brisbane. Yes, I'm breaking my own rules, I know. Firstly, let's cover Brisbane's property market, which is a story of transforming from a slower moving capital city overshadowed by Sydney and Melbourne to a nationally significant investment destination. Historically, Brisbane's market has been characterised by affordability compared to our southern capitals. Median house prices for decades lagged Sydney and Melbourne by wide margins, offering value but slower growth. This meant periods of underperformance where investors chasing fast capital growth overlooked the city. That shifted noticeably from the 2010s onwards, when interstate migration flows began tilting to the north. Brisbane's lifestyle appeal, relative affordability, and growing economic base attracted families and professionals priced out of Sydney and Melbourne. This migration underpinned both rental demand and sales activity, laying the groundwork for the next major growth phase. The COVID-19 pandemic accelerated that trend. A wave of people migrated north and house prices surged more than 40% between 2020 and 2022, one of the strongest growth periods in the city's history. Rents followed, tightening vacancy rates to record lows and creating landlord-favourable conditions. Even in August 2025, national data had Brisbane recording the largest monthly gain among capitals, up 1.2%. The state government's Shaping Southeast Queensland plan forecasts Greater Brisbane will add 1 million extra residents by 2046, taking it from 2.9 million to a population of 3.88 million, requiring about 556,400 additional homes and creating a $275 billion per year economy. This positions the region as a core growth engine, with population demand and economic growth locked in for decades. To house this population, the state government have pivoted to a 70-30 infill to expansion ratio, meaning higher density, low, medium and high-rise attached developments are being prioritised around transport corridors and centres. Yet approvals and completions have lagged well behind, with REIQ pointing out just 35,800 approvals were achieved in the year to January 2025 versus the 49 to 50,000 needed. This imbalance continues to place upward pressure on prices and rents. Infrastructure delivery, including transport upgrades and preparations for the 2032 Olympic Games, adds further long-term demand drivers, but also strain on construction approvals and completions. For investors, the market presents both opportunities and risks. On one hand, durable population growth, a diversifying economy, and constrained supply underpin its outlook. On the other, affordability pressures and rising construction costs temper short-term momentum. Brisbane is no longer the underdog capital, but a maturing market. It's gone from a cheap alternative to a core investment market where strategic buying is now absolutely essential. Melbourne, on the other hand, holds the title of Australia's strongest long-term property market over the past 40 years. Its track record of steady capital growth, supported by a diverse economy, strong migration, and deep housing demand, has historically made it a safe bet for investors. But the past 5 years have been a roller coaster. After ultra-low interest rates and COVID stimulus pushed prices to record highs by early 2022, the market then hit the brakes. Extended lockdowns, closed borders, and population losses dented demand and investor sentiment. In fact, Melbourne lost around 61,000 people in just 1 year as residents sought lifestyle shifts to Queensland or other regions. When interest rates surged in in 2022 and 23, prices pulled back further, and Melbourne became the only capital city with negative capital growth in 2024. By early 2025, dwelling values remained 3 to 4% below their 2022 peak, while Brisbane's median price actually overtook Melbourne's for the first time in 14 years. The market underperformed not only against Sydney, but also Perth, Adelaide and Brisbane, a rare event and role reversal for a city that usually leads. Why the weakness? High supply levels kept listings elevated when other capitals were tight. Investor confidence was shaken by Victoria's tougher tenancy laws and rising holding costs. Rental stock fell sharply as landlords exited, with around 24,500 fewer rentals across Victoria by 2024. It meant Melbourne missed much of the COVID-era boom. It still has 2021 and 2022 prices, whereas all other capitals have accelerated. Today, Melbourne's house prices are around 41% cheaper than Sydney's, a gap of about $600,000, the widest in 20 years. But the tide is turning. As of September 2025, prices have risen modestly with 7 consecutive months of growth, signaling the bottom of the market might be behind us. Rental yields have strengthened, vacancy rates remain near record lows, and migration continues to drive demand across both inner city apartments and suburban houses. The recovery is largely about the return of international migration and the city's underlying fundamentals reasserting themselves. Greater Melbourne is home to 5.35 million people, 77% of Victoria's population and nearly 20% of Australia's. In 2023-24 alone, it added 142,600 residents, the fastest growing city of any capital city. By 2035, the population is projected to reach 6.4 million, and by 2051, around 8 million, coming very close to reaching or even surpassing Sydney's in the long run. 3/4 of Victoria's jobs are in Melbourne, and its job outlook is strong, needing 277,000 additional workers by 2026 alone. Victoria's published housing targets aim to build 1.78 million more homes in Melbourne out of the 2.24 million homes it plans to build statewide by 2051. Much like Queensland, Victoria wants 70% of new homes to be built in established areas and 30% greenfield development with similar density targets. However, the state saw a deep approvals slump through 2023-24, the lowest annual tally since 2013, constraining the new home pipeline into 2026 and 2027. From being a property powerhouse to having a pandemic-era slump, today's early recovery signs mean Melbourne is re-emerging as a city of opportunity. Now, we have full analysis videos specifically on each of these two cities where we dive deep. Literally 20 minutes each video dedicated to each city. Nothing else on YouTube exists like them. So check them out if you want more detail on what we just went through, because now we're taking a look at both these cities side-by-side comparisons. When it comes to vacancy rates, as of August 2025, Brisbane's rental market remains extremely tight, hovering at 1%. Melbourne is now tighter than pre-COVID, broadly sitting at 1.8%. Both are well below the 3% marker of a balanced market. Greater Brisbane ended September with a median house price of $1,062,109 and a median unit price of just over $755,000. Combined, the city's median dwelling price sits at $969,868. This represents a 1.1% increase compared to September 2025, meaning Brisbane property values have risen by 80.1% over the past 5 years. Melbourne ended September with a median house price of $953,500 and a median unit price of nearly $629,000. Combined, the city's median dwelling price sits at $805,880. This reflects a 0.5% increase compared to September 2025, meaning Melbourne property values have increased by 17.5% over the past 5 years. In September, weekly asking rents in Brisbane were $779 for houses and $613 for units. Melbourne's were $768 for houses and $576 for units. These broad metro figures calculate to indicative gross yields of Greater Brisbane being 3.81% for houses and 4.22% for units, and Greater Melbourne 4.18% for houses and 4.76% for units. Important to note, though, that actual yields will depend heavily on vacancy within specific suburbs and associated rent prices demanded from that, the dwelling type, characteristics, and financing costs. But this is a solid indicative analysis at that metro city level, comparing buying prices with rents. Using published totality affordability data, Brisbane has a combined yield of 3.6%, down from this time last year, while Melbourne is at 3.7%, up from this time last year. Melbourne edges higher on more affordable entry points across many rings as Brisbane's affordability has tightened materially post-boom. Holding costs. Queensland land tax for individuals kicks in once the combined unimproved land value exceeds $600,000. Victoria's is just $50,000, meaning far more investors now face land tax liability. On the flip side, day-to-day holding costs such as council rates and insurance often run lower in many Victorian LGAs compared to Queensland's that are generally more risk-prone. That means while Brisbane investors benefit from a higher tax buffer, Melbourne investors must weigh heavier land tax exposure against somewhat softer ongoing charges. In practice, they generally balance themselves out near enough. Both cities have powerful population stories, but manifested differently. Melbourne's sheer scale and inflows refill inner and middle ring demand quickly. Brisbane's growth disperses across multiple fast-growing LGAs, creating satellite cities or micro markets differing in entry points and value-add plays. Both cities are mid-infrastructure upgrade. Melbourne's big build continues to reorder accessibility across key corridors, supporting inner and middle ring densification. Brisbane's plan bakes higher density around high-frequency transport and activity centres. The takeaway is identical. Buy with the network, not against it. But remember, not all infrastructure is equal. It doesn't mean automatic gains. You need to know what to look for, and we have a very detailed video specifically on infrastructure that's worth checking out, and the link is just down in the description. In terms of the underlying fundamentals, both cities have a bright future. Now, before we can start analysing each city's future forecasted outlook, I first need to give a very quick rundown on how property cycles work, so each city's cycle position can then be explained. Property cycles are the repeating pattern housing markets move through. They roll through 4 phases: the upturn, which is when prices start to pivot upwards; the boom, which is when prices accelerate; the downturn, when prices start to dip; and finally stabilisation, when prices level out and the market recovers. Each phase is driven by shifts in demand, supply, interest rates, and credit. Then it all starts over again. An easy way to visualise this is looking at Australia's last 30 years of property market history. You can see the cycles up and down, and that's what the property market does. But remember, cycles aren't just at a national or state level. Every LGA and suburb operates in their own microcycles too, which is why exact suburb selection is so important. We have a very detailed video on property cycles. It's a fascinating topic, and the link is just down in the description. Brisbane has just had years of accelerated growth. It's well entrenched in its boom phase after years of slower growth prior to that. No market can keep growing at this rate forever because affordability erodes, and no one could afford to buy or rent there if it did. Moving on to Melbourne, after years of downturn and more recently stabilisation, it certainly looks like the market has recovered, and it's in the early stages of an upswing, having now posted 7 months of consecutive growth. This means that it has a lower base of value to then grow from. So why am I showing you all this? Because ultimately the question of which market to buy in comes down to pro-cyclical and counter-cyclical investing. Buyers usually flock into markets or hotspots well after price and rent acceleration is obvious. Once lots of people have heard about the location and the excitement has heightened demand and tightened supply. By that point, a market is usually entrenched in the upswing or boom phase of its cycle. This is called pro-cyclical investing. You're buying with the cycle. Buying in Brisbane right now is pro-cyclical investing. The city is booming and prices have already accelerated. There can still be good buying, but you need to be surgical about micro-location. Investing pro-cyclically at the right time means you may achieve rapid gains in a short time frame, just like if you bought in Brisbane a few years ago. But be careful you're not too late to the party, because prices have already accelerated by this point. So you need to make sure most of the growth hasn't already passed, and the underlying fundamentals show there's still room for prices to continue climbing before they decelerate or stabilize. Now, the opposite of pro-cyclical investing is called counter-cyclical investing. This is when markets are targeted nearer the bottom of their cycle, so in the stabilization or very, very early in the upswing phases, well before locations are known as hotspots. Not a lot of buyers would have piled into that location yet, as sentiment is low, so property values are lower. They haven't accelerated yet. Melbourne is a counter-cyclical play right now, but that is changing rapidly rapidly. Buying counter-cyclically means you may have to wait a year, maybe 2 or 3, before the upswing starts, depending on where the cycle position was when you entered that market. If accelerated growth in the near term, 1 to 2 years, is needed or wanted, buying counter-cyclically probably isn't the best strategy. But that also means the full use of the cycle's upswing and boom phases aren't being utilized to squeeze as much profit out of that property as possible. To the contrary, buying counter-cyclically means you can take advantage of the full cycle, but it could take some time. So, deciding which is really just dependent on your own circumstances and strategy. Let's start off with Brisbane. Domain forecasts a 5% rise in house prices by financial year 26, reaching a median of 1.09 million, while unit prices are expected to also rise 5%, hitting $701,000. Slow supply response across southeast Queensland will help maintain strength even as approvals gradually improve from their lows. Cash flow will remain solid in well-chosen pockets, especially near transit, jobs, and areas with tight vacancy rates. That said, affordability constraints are already biting. Many households are dedicating upwards of 50% of their incomes to mortgages, up from just 28% in 2019. So price growth is forecasted to slow more in line with wage growth. Suburbs experiencing their own micro-cycle booms can be found, but surgical analysis is needed. Over the longer horizon, a 1 million person uplift and 70-30% infill strategy will increasingly re-rate land close to transport and employment hubs in inner and middle ring suburbs across Brisbane, Logan, Moreton Bay and Ipswich. Houses will slowly get bulldozed for high density attached housing, which will claim a large share of both stock and transactions. Constraints on trades capacity causing delivery bottlenecks will continue to slow the pace of new supply, supporting capital growth and rental pressure over time. Let's get into Melbourne. Domain is forecasting around 6% growth in house values and around 5% for units across FY 25-26, pushing houses into new peak territory while units regain ground toward previous highs. This kind of recovery is precisely the setup counter-cyclical investors seek. In the medium term, strong population inflows combined with constrained new housing approvals to underpin capital growth and rental tightening. Over the long term, Melbourne's fundamentals remain among the strongest in Australia. Its diversified economy, deep employment base and scale make it well insulated against single sector shocks. Population projections mean demand pressure on land is inevitable. That said, a few headwinds must be watched. State finances are stretched. Policy uncertainty, especially tax and planning regulation, could dampen sentiment. If you favour counter-cyclical upside and relative value, Melbourne gets the nod. It's more affordable on multiple measures and is projected to be a top 2 growth leader over FY 25-26. The current $600,000 difference in median prices between Melbourne and Sydney historically narrows during its upswings and as interest rates ease. With some prices generally at replacement cost, buyers entering the market can effectively lock in gains before the next rebound starts. If you favour yield, low vacancy and structural undersupply, Brisbane still stacks up. Expect rent pressure to stay firm while vacancy remains squeezed and supply struggles to catch up. But note that entry prices are less forgiving. This is no longer the counter-cyclical play it once was when we started buying in Brisbane back in 2018. You now need surgical precision when selecting your suburbs. Remember, property needs local knowledge. Whether you are needing to find the exact growth suburb in Brisbane or the right counter-cyclical market play in Melbourne, we can help you with all of that. Just give us a call or visit our website and book a free chat with Boyd and I so we can run you through the details. Until next time, happy property navigating.